Regime change is coming to the United States. Those aren't my words. They belong to Kevin Warsh, the newly minted chairman of the Federal Reserve. Standard protocol tells incoming Fed chairs to preach continuity. They want to soothe the markets. But Warsh is angling to completely tear down the post-2008 era of endless money printing and rebuild how the central bank operates. To understand his blueprint, you have to look back to the legendary economist Milton Friedman. Warsh considers himself a student of Friedman, anchoring his worldview on one core rule. Inflation is first and foremost a monetary phenomenon. This makes him the absolute antithesis of his immediate predecessors. For years, the bureaucrats running the Fed dismissed monetarism and continuously gaslit the public by insisting that rising prices were merely transitory. Warsh knows the mechanical truth. What actually sparks inflation is an intoxicating cocktail of excessive government spending paired with relentless central bank money creation. Everyday consumers don't run the printing press. Temporary shocks can cause localized price spikes, but the prevailing narrative that supply chain hiccups or corporate greed drive long-term prices higher is just a convenient smokescreen. Sustained inflation is manufactured exclusively in Washington. But here is where the economic gears start grinding against reality. When everyday citizens talk about inflation, they are looking at the grueling prices they face at the grocery store. This volatile bar chart represents exactly how those wild price swings look on paper. Because Warsh prefers not to judge policy by short-term swings, he favors a metric known as trimmed mean inflation. It acts as a financial filter that aggressively cuts out the highest and lowest price anomalies to find a stable average. The inherent danger in this math is what it erases. Sudden, real-world shocks, like overnight spikes in oil or runaway food prices, get completely removed from the calculation. If policymakers base their decisions on that engineered, sanitized number, they suddenly have the perfect mathematical justification to prematurely slash interest rates. On paper, Warsh is an inflation hawk who knows the truth about money creation. But even a hawk might be forced to use these sanitized numbers to cut rates because of the inescapable fiscal trap he just walked into. This massive, compounding red line you are looking at is America's national debt, nearing $40 trillion after over a decade of quantitative easing. The tiny blue line at the bottom is traditional economic growth. We cannot outrun this gap. This is the immovable object. If the Fed tries to hold interest rates high to choke out inflation, the U.S. government's annual interest payments immediately explode past $1 trillion a year. Making matters worse, global demand for American debt is plummeting. When demand drops, bond yields are forced to climb higher and higher just to attract buyers. Warsh remains highly optimistic he has a way out. He theorizes that the unfolding artificial intelligence revolution will act as a massive productivity boom, driving costs down and saving the economy. Countering. But the sharpest minds in finance aren't buying it. Tech conglomerates are projected to spend close to $1 trillion this year alone on capital investments to build that AI infrastructure, issuing historic amounts of high-yielding corporate debt to get the cash. As global investors rush to buy up those lucrative tech bonds, that astronomical capital has to be drawn from somewhere. It violently siphons vital liquidity entirely out of the U.S. Treasury market. The AI boom isn't cooling inflation down. By drawing money away from government bonds and forcing borrowing costs up, it is actively pouring high-octane fuel directly onto the fiscal fire, and that dynamic could persist for years. Which forces us to confront a cynical yet entirely logical question. Is this elaborate debate over inflation metrics and interest rates just a coordinated cover story to save the national debt? Just think about the massive financial incentive. If the Treasury can point to a trimmed, artificially low CPI to justify dropping interest rates, they can refinance their mountain of maturing debt and save trillions of dollars. The playbook is hidden in plain sight. No heavily indebted empire in human history has ever successfully paid back its obligations with sound, honest money. Sovereign debt burdens are almost always liquidated through a deliberate, slow burn of inflation. The bill for this grand monetary experiment is handed directly to the most vulnerable. Disciplined savers, retirees scraping by on fixed incomes, and anyone holding dollar-denominated assets quietly pay the price. As the government erodes the real value of what it owes, that stolen purchasing power doesn't vanish into thin air. It is actively extracted from the public to subsidize the state's survival. Policymakers can stand at a podium and introduce sleek new statistical models all they want, but Warsh's ultimate insurmountable opponent is the global bond vigilantes, the massive institutional investors who actually buy American debt. If those international investors refuse to believe the narrative they are being sold, and they see right through the sanitized inflation metrics, the entire charade collapses. If they lose faith, bond yields will continue their relentless march upward. When the market rejects the story, clever playbooks and central bank rhetoric become completely irrelevant. The Federal Reserve will ultimately be forced to make a catastrophic choice: protect the value of the currency or protect the survival of the debt, save the purchasing power of the American dollar or save the rigged financial system. Kevin Warsh can champion regime change every day of his tenure, but his ultimate challenge is convincing the global market that America's debt load is sustainable in real purchasing power terms, not just in nominal dollars. Economist Murray Rothbard once laid out a brilliant analogy for this exact illusion. He likened the central bank to a professional thief who robs a pedestrian, sprints down the boardwalk, and then spins around to point frantically down the street, shouting, "Stop, thief!" When the Federal Reserve was quietly manifested in 1913, it was meticulously designed by a cartel of powerful bankers. It was never engineered to rescue the working class or fight inflation. It was built to create an elastic, endlessly printable currency. This circular flowchart maps out a compounding mathematical trap known as a debt doom loop. Rising yields force the United States to spend more. To cover that, they must issue more debt and print money. That drives inflation higher, which pushes yields right back up. You cannot easily halt a runaway economic freight train. No matter how fiercely the Fed promises reform, the math guarantees one unavoidable outcome: the systematic destruction of the purchasing power of every single dollar you earn.